Hello everyone. A very good morning to all of you and vanakkam. So myself Bhavik and I will be doing the refresher course with you. So we will be trying to cover the entire financial reporting and so you will have 3 books over the course. So there will be one compact concept book which is called as the Shield. That will cover all the concepts, so that can be with you even literally on your exam day when you can go for the IBS paper. So you can carry that. It's a fairly comprehensive coverage for your all concepts. Then we will have 2 volumes, volume 1 and 2. Within volume 1 and 2, we will cover all the questions which are relevant. So there are 400 plus questions and uh, uh, almost if you pick up any of the last probably 8 to 10 attempts over the course of the past years, almost every question that has come in the past exam is there in that book, in the sense that all concepts will be covered. So there are a lot of questions if you have done which is linked to some basic concept building. So we will discuss them, but largely all the important questions are there in those 2 volumes. So we will cover the important questions. We will do it in class. If possible, you should at least try to cover up the questions that we do on that particular day on the same day before you come on the next day, so we are at good speed. Okay, and again it is a batch where we would want to balance concept coverage with the limited time that we have, right? So if you have any questions, feel free to raise your hand, ask the doubt, or you can even type it on your comment box, and otherwise we can also cover it after the course of the batch. Okay, so are we good to start? Chalo, that's great. Make some more noise here. Yes, are we good? Chalo, that's audible. So we will start with financial reporting. Now before we proceed, we will just do a basic introduction for our Ind AS on the applicability of Ind AS, and then we go into the core topics. So the way we flow through the syllabus would be, we will do first the asset linked standards. You have PPs, you have intangibles, investment property, and all of this. We'll finish the asset linked standards, then go to share based payment and financial instruments. So there you are a little drained out. Then again come back to standards, then again go back to business combination, consolidation, and that way kind of finish off this course. Okay, fair. So we'll start with Ind AS, a basic introduction in the sense, in terms of your coverage, you'll have obviously a 30-mark MCQ paper now and a 70-mark descriptive paper. Within the MCQ paper, it's just one attempt told. But if you are done with your concepts, MCQ should flow through quite easily. It is not, you'll have separate ICI, BOS MCQs. We have also shared separate MCQ files. But nevertheless, if you kind of do your core correct, MCQs are by and large sorted. You don't have any other preparation to do specifically for the MCQs. Okay. So first we go to the introduction to Indian accounting standards. Ind AS, it's a fairly basic topic on what is Ind AS applicable. So when we did our CA Inter, did we study about Ind AS? Yes. Okay. So okay, when we did CA Inter, we studied what? We studied accounting standards. We studied AS. Now we go to Ind AS. So unlike you have something like GST, earlier you had service tax. Service tax got replaced by GST. It's not a parallel application, but Ind AS and AS are parallelly applicable. So there are certain companies to whom AS is applicable, certain companies to whom Ind AS is applicable. According to you, Ind AS is applicable to which companies? The bigger ones or the smaller ones? Bigger ones would apply Ind AS. The smaller ones will still continue to go as per AS only. Now, why do I need to move to Ind AS in the first place? Why do we even need Ind AS in the first place? What was wrong with AS? Fair evaluation was a problem. Okay, so international standards. So what happens is, let's say if you will, it's just a matter of time, you will clear CA in some time, right? Okay, and then you decide to, let's say, go overseas. You want to do a foreign trip. Generally, where do Indians go? Generally, most common places: US, UK, Dubai. Okay, so a lot of places we have in mind. We just have to get the degree. But largely, what is the common thing that binds? Okay, most of the times we would go to US, UK, Australia, etc. It is because we have relatively limited language barrier. We understand English, they also understand English, and hence we would say, "Yeah, let us go to a relatively safe place, even if we have to go for a 2-week vacation." Right? I mean, there would be people who can go to Japan, South Korea, etc. But again, you are kind of worried that what will we eat, we don't know. So, so that is why we want to be in a place where we are understood. The same applies even for an investor who is putting in probably millions of dollars. So they would want to invest in a company whose language they understand. And what is the language that a company speaks? They speak through their balance sheet. So balance sheet is prepared using either accounting standards, which is given by our ICAI, but it is not internationally accepted. Or it can be prepared using what we say as IFRS. Now, IFRS is International Financial Reporting Standards given by IASB, and it is there in approximately 150, 160 countries across the world. So that is why an international investor is much more comfortable if they know that, well, you know what, these are balance sheet prepared as per IFRS. We know IFRS, so we know what is there in the balance sheet. The moment they see that balance sheet as per AS, it's a natural kind of a pushback. They would say, "Nahi yaar, we don't really know this company, let us not get into this company." And hence, we wanted to move into an international accounting framework so that our companies are much more internationally accepted. And hence, we decided to move into Ind AS. Now, Ind AS is kind of a bridge between AS and IFRS. There are a few differences between IFRS and Ind AS. There are around 12 to 14 differences. It is not there in your syllabus, but wherever they are, we will kind of discuss that. They are called as carve-outs. What do you mean by carve-outs? IFRS is an entire framework. There are some differences which are different in Ind AS, considering the Indian landscape. Like in India, inflation is a reality. So there is an escalation clause almost always there in every agreement. Internationally, if you look at US, UK, there is hardly 1-2% inflation. Now for that, to put an escalation clause is also, what will you escalate for 0.5%? And hence, it is not that big a problem. So they have not given you a lot of guidance. We want a lot of guidance in leases. Or you have something like business combination. In business combination, have you heard PC purchase consideration minus net assets? If the difference is positive, where does it go? Goodwill. But if it is negative, where does it go? Why capital reserve? Why not P&L? Oh, a lot of things are not day-to-day. You don't sell land in the day-to-day course of your business. You don't win lotteries in the day-to-day course of business. Everything goes to the P&L. Sale of land goes to P&L. Don't sell it in day-to-day course. If you win a lottery, goes to P&L. Then why do you take the difference to capital reserve? It is probably the only place where there's a profit on purchase. It's capital in nature, undoubtedly, but every profit that you see is a profit usually on sale. It's realized profit on sale. Here, this is profit on purchase. You are purchasing something and recognizing a profit. Usually when you purchase inventory, you go to a mall, there is a offer going on, you purchase goods at half the price. You don't recognize a profit. You recognize if you sell it at a price which is higher than this is the only place. One of the very few places where you recognize a profit on purchase. So the standard says, well, you know what, this is really special. It is not day-to-day rightly put in, but at the same time, this is a profit on purchase. You do not really take the profits on purchases to profit and loss account. And hence we said, no, this is capital in nature, we should go to the capital reserve only. But IFRS has a slightly different thought process. They said, no, even if it's a profit on purchase, so what? Let it go to the profit and loss account in certain cases. IFRS. We say, no. If you do such things, then in India, we have what you call setting jugadu mindset. So it's quite literally said that it will result in artificial restructurings. People will restructure and create profit. If you allow it to be taken to profit and loss account, and hence we don't want to take it to profit and loss. So there are certain differences which we have said, and there are 12 to 14 differences, and that's it. And we will study it when it comes, just for our overall understanding. But other than that, we kind of follow IFRS, and hence it is called as Ind AS. We try to converge into Ind AS. Are we clear with this? Okay. Now we said it is applicable to larger companies. Do we need to understand to whom it is applicable? Well, in general, yes. The May 24 paper, the exam paper that just went by, had a 4-mark theory question. Explain to whom is Ind AS applicable. 4-mark theory question. In general, out of your 70-mark paper, I would not see more than 4, max 8 marks of theory. Everything else is going to be largely a numerical. It can be sums or it can be cases, but there can be theory questions, and this was one of them. So to whom is Ind AS applicable? Phase-wise applicability. First, we started in the year 1516. In the year 1516, we said that voluntarily, if anyone wants to follow Ind AS, you can follow Ind AS. You think that would be successful? Now, if you are given voluntary subjects, SPOM, right? Okay, so we are not very serious about it. Unless we are forced to do it, we are not going to do it. So it was kind of a failure. That was not many companies went into Ind AS. So they said, well, you know what? We have to make it mandatory. People are not going to voluntarily move to Ind AS. So we'll make it mandatory. So in phase 1, they looked at companies which is having a net worth of greater than or equal to, any idea? Any idea? Okay, greater than or equal to 500 crores. So whether it's a listed company or unlisted company, 500 crores was a number. From an exam perspective, I don't really see a lot on phase 1 now, because phase 1 was only there for the year 16-17. Now, from 17-18 onwards, there is no phase 3 yet. As we speak, there's no phase 3. So from 17-18 onwards, if you are a company whose net worth as an unlisted company or a private company is greater than or equal to, any idea? 250 crores. Or you are any listed company except your company is listed on the SME platform. For every company which is listed, no matter how small it is or how big it is, you will have to comply with Ind AS. So for you, from an exam perspective, what you have to remember is, for every unlisted company having a net worth of greater than or equal to 250 crores as on the last audited balance sheet date, Ind AS is applicable. And for every listed company, irrespective of the net worth, it does not really matter, Ind AS becomes applicable. Are we clear with this? So that should kind of suffice. So this is your applicability, and when you look at the applicability for listed companies, the only people who are exempted over here are companies listed on the SME platform. Remember, when you study MCQs, exceptions become important. So the small things which you would earlier ignore, okay, this will not come as a bigger question, becomes important when it comes at a smaller MCQ level, because even if you've seen DT, etc., where you have had a history of MCQs, what comes in MCQ is generally these exceptions, small things. What comes in the main paper is the core thing, right? So these small things are also relevant, okay? Now, this is where Ind AS becomes applicable in general. Now, when I look at the balance sheet, few small things. I said net worth has to be greater than 250 crores. But if you have done your articleship and in audit, you might have seen a lot of companies having 2 balance sheets in their annual report. Which 2 balance sheets? Standalone, consolidated. Is the net worth same in both of them? But then when I talk about 250 crores is which net worth? Standalone. Almost every regulation across India, not just in FR, DT, everything, almost every regulation applies on standalone, not on consolidated, because your consolidated is very difficult. Every company has a unique UCIN number, PAN number, all of that is just a second. Okay, all of that is actually applicable for a standalone only, because you can have a PAN number, UCIN number on an individual basis. Consolidated, if something happens, whose neck are you going to catch? It's a group, right? And hence you will look at standalone net worth, not consolidated net worth. You will look at standalone net worth. Are we clear with this? Okay, and when we look at net worth, this is net worth as per the last audited balance sheet date. So when you look at the last audited balance sheet date, the net worth, what will be there in net worth? Will share capital be a part of net worth? Acha, when you look at share capital, which share capital? Will equity share capital be a form of preference share capital? Now this is a little contentious, right? Because under AS, preference share capital were like owners. Under Ind AS, if you know, we will study further, but under Ind AS it sometimes becomes a liability. But your last audited balance sheet was AS balance sheet. In your balance sheet, the law says share capital plus reserves excluding revaluation reserve. So in your AS balance sheet, if it was as a part of share capital, you take it as a part of net worth. If it was not a part of your, usually preference share capital was a part of your AS balance sheet in share capital. So even preference share capital, because last audited balance sheet was AS balance sheet, in that preference share capital was share capital, that is also a part of your net worth. Share capital, equity and preference both, plus reserves. You will include almost all reserves except for revaluation reserve, and less any fictitious assets. This is a Companies Act definition of net worth. Are we clear with this? Fictitious assets, any idea? Is building fictitious? No, but is underwriting commission not yet written off fictitious? Preliminary expenses not yet written off fictitious? Yes, these are expenses, not really assets. So that is your basic net worth definition. Okay, so this is regarding basic net worth. The bigger provision which brings a lot of companies into its fold is the group provision. Like for example, a few years back there was COVID, and in COVID earlier, if one family member gets positively detected, the entire family was quarantined. And that is the same thing that is happening over here. If one company in your group touches Ind AS, and when I say group, it includes what? It includes your parents, it includes your subsidiaries, it includes your associates, and it also includes something called as joint venture. We will study further and come to a point where we try to understand the difference between a joint venture and a joint operation. Joint operation will not be applied for Ind AS, but joint venture, yes. So what is difference? We will study that. But for the time being, just remember that your parent, subsidiary, associate and joint ventures, all of them will touch upon Ind AS. Now, some of them may be a Section 8 company, you understand? Charitable purpose. We say so be it, it's still a company. And as a result, every entity in your group, the moment one of them touches Ind AS, every other entity will also touch Ind AS. Is it mandatory or optional then? Mandatory. It is mandatorily required. Are we clear with this? Yes, okay. The only exception over here is a joint operation and also something called as a fellow subsidiary. You understand what is meant by fellow subsidiary? Well, there is a parent, there is S1 and then there is S2. So when I look at, let's say S1 crossing the limit, for S1, if S1 crosses the limit, let's say S1 is like Tata Steel. Tata Steel crosses a limit, so its parent company Tata Sons, for example, will automatically go under Ind AS. So if subsidiary follows Ind AS, the parent will automatically go under Ind AS. Now the question is, will a fellow subsidiary also fall under Ind AS framework? Theoretically, yes. Why? Because, well, if parent is following Ind AS, then S2 automatically will go under Ind AS. But this law gives you an exception over here. If parent has direct applicability, like if parent had a net worth of greater than 250 crores, or if parent was listed, then S2 no choice. You have to follow Ind AS. But if parent has indirect applicability, well, parent is following Ind AS because one of its subsidiary followed Ind AS. Then for fellow subsidiary, it is not mandatory. So two things you have to remember. One is joint operation will not follow Ind AS. A classic example of joint operation is like unincorporated partnership firm. Yeah, whenever an unincorporated partnership firm, it's a joint operation for simplicity at this stage. That a partnership firm will not go into Ind AS merely because one of the partners is following Ind AS. Also, second is fellow subsidiary. Merely because my fellow subsidiary is following Ind AS does not mean I have to follow Ind AS. If I want to voluntarily follow, Acha, can I voluntarily follow Ind AS? Yes, but mandatory applicability is not there. So these two things you have to remember. Are we clear with this? Yes, okay. So if S2 wants to voluntarily, in practice, majority of these companies will follow Ind AS. In practice. Why? Consolidation has to happen using uniform policies. So if S2 is following AS, in any case I have to consolidate with P. Then practically I will say, why should I make them follow AS? Forget it, I'll make them follow Ind AS, but that is voluntary. Mandatory applicability is not there for a fellow subsidiary. Any problems till this stage? No, can we proceed further? Okay, so in my opinion, the most important applicability that applies in practice is the point 4 applicability, the group applicability. That if it is applicable to one entity, it automatically becomes applicable to other entities within the group. Are we clear with this? And when I say other entities, it also includes associates, also includes joint ventures, does not include joint operations, does not necessarily include fellow subsidiaries. Are we clear with this? Okay. What if I've not covered in the roadmap? What if I'm not yet covered under the roadmap for Ind AS? Then I will follow what? Yes, I will follow previous gap. But let us say I decide to voluntarily follow Ind AS. And then after 1 year I said, no. I cannot manage all of this. I want to again go back to AS. Can I go back? No. You have to, once under Ind AS, always under Ind AS. So later you may be delisted. You are listed. Later you might be delisted. Your net worth might fall below 250 crores. Whatever by the reason, the moment you go under Ind AS, there's no coming back. You prepare one Ind AS finance statements, you are stuck for life. Right? You have to continue to follow Ind AS only. Okay. So this is considering the companies in general. Now this is the applicability for a common company, let's say that we have in the exam X Limited. But there are certain financial institutions, notably banks, insurance companies and NBFCs. For them, there is separate applicability. What we will study here and across the syllabus is largely going to be for a regular company, X Limited, Y Limited, whatever it is. But what if, let us say, you are a specialized institution like a bank, NBFC or insurance company. So as we speak today, for insurance companies and banks, Ind AS is not applicable. It is deferred until further notice by either RBI or IRDA. Having said that, just for your general knowledge, internationally there has been an IFRS 17. The last IFRS that you have in your syllabus is IFRS 16, which is corresponding to Ind AS 116, which is leases. Internationally, you have an IFRS 17 now, which is going to be applicable from the next year. That is on insurance. Before that, we have to clear. Right? Okay. So, as we speak, it is not relevant, but maybe once IFRS 17 comes in, there will be Ind AS 117, and most likely that is when IRDA will allow insurance companies to move to Ind AS as well. But by that time, we will be qualified. Right? Okay. So, right now, to banks and insurance companies, it is not applicable. However, for NBFCs, you understand the difference between a bank and an NBFC? What is the difference? That's right. You said something. I agree to that. So over here, you have banks. In banks, you can have demand deposit called as saving current account. You can write a check. In NBFC, you cannot write a check. Something as basic as that. You don't have a saving or current account against which you can write a check. In NBFC, at max, you can make fixed deposit. Banks also you can make fixed deposit. NBFC cannot have current and saving account. Bank will have current and saving account. So generally RBI is more worried about banks because people's hard-earned money is in saving current account. So RBI said, okay, let us see how things go and then we make it applicable to banks. As of now, they've allowed NBFCs to move to Ind AS. What is the roadmap for NBFCs? A +2 roadmap. What is +2? What happened in 2017-18 +2, 2017-18 +2, 2016-17 +2, for example. So for an NBFC, in the year 2018-19, if my net worth is greater than 500 crores, or if I'm listed with net worth of more than 500 crores, I'm like Mannapuram Finance, Cholamandalam Finance, Muthoot Finance, these are big listed NBFCs, right? If my net worth is greater than 500 crores or if I am listed, then in the year 18-19 I will move to Ind AS. Again, for your important purpose, for the year 1920. In the year 1920 onwards, same applicability. 250 crores for unlisted and for listed, no net worth criteria. You will have to follow Ind AS if I'm a NBFC. And there are a lot of NBFCs in the market, okay? So that way they have also moved to Ind AS. From an exam perspective, NBFC is relatively less important. Your regular company is more important. But then what is going to make it complicated? Group. What if I'm a company where I have an insurance company in my group? Like you have heard about Future Group? Kishore Biyani. Future Group has an insurance company called as Future Generali. Now Future Group is not a financial institution. It had companies like Pantaloons, etc. earlier. Big Bazaar, Pantaloons, etc. earlier. But one of its group companies is insurance company. Are we understanding it? Or there is Bharti. Have you heard about Bharti? Airtel. Now Bharti has Bharti AXA. Now, Bharti AXA is insurance, but Bharti Airtel is nowhere connected to that. So now if my company has a group, let's say there is P, and below that sits an insurance company. Let's say there is an insurance company S1, there is a regular company S2. So in general, if I look at P, now let's say Future Group has a net worth of greater than 250 crores. Then ideally for Future Group, will Ind AS become applicable? Acha, for its regular subsidiaries, will Ind AS become applicable? Yes. Now the problem is insurance company. By default, does insurance company Ind AS become applicable? Yes or no? Louder, louder. No. But then it is a subsidiary of a company, and we have learned that the moment parent becomes Ind AS, subsidiary also Ind AS. So will insurance company have to follow Ind AS because it is subsidiary of a company following Ind AS? Yes or no? Subsidiary, associate, joint venture? Are you sure? Sure. Answer change karna. Yes, okay. So, okay, we stick to our answer. Perfect. Ind AS is not applicable. Even if my parent is following Ind AS, so what? If I am a bank, I am an insurance company, or NBFC subjected to certain limits, I will have independent application and not application because of my parent. Are we clear? Ind AS is still not applicable when they prepare their SFS. You understand SFS? Separate or standalone financial statements, Ind AS is not applicable. Perfect. But will P have to prepare CFS? But when I prepare CFS, I'll have to consolidate S2. Here I'll also have to consolidate S1. But S1 is as per IGAP, that is AS. But now I have learned that consolidation happens based on uniform accounting policies. So now can I consolidate insurance company with P which is following AS? Well, the law says that I will have to follow uniform accounting policies unless it is impracticable. Which means in practice, what almost all of these companies like Future Group, Bharti Group, what all of them do is they will restate their financials of the insurance company to the extent possible and extent practicable to Ind AS and then consolidate. So consolidation will still require, you will have to take your insurance company's financials, restate them as per Ind AS to the extent practicable and then consolidate. So from an exam perspective, and you have in the new study material 8 questions. We have selected 3 or 4 of them, but in the new study material of May 24, earlier in the old study material, if you have prior to the new course, there were no questions in this chapter. Now there are 8 questions, of which we will be doing 3 or 4 of them, where they have asked you questions like this, that what will happen if my parent company is an regular company with Ind AS, my subsidiary company is an insurance company, an NBFC for example, to whom Ind AS is not applicable. Your answer will be, in the SFS of the insurance company, will Ind AS be applicable? But for consolidating the insurance company with the parent's financials, will I have to restate as per Ind AS? Perfect. Are we clear with this? Can we proceed further? Okay, so this is regarding restatement. So additional guidance over here, point 2, if you see, Ind AS need not mandatorily apply to a fellow subsidiary. However, parent may need to restate financials of that company for consolidation. This is regarding fellow subsidiary. Third, in case there are banks or insurance companies or NBFCs in a group, they may continue under accounting standards. This is for their SFS. However, for consolidation, their financial statements may be restated to Ind AS to the extent practical. Are we clear with this? Okay. Now there is one small thing for which institute has asked you a few questions in the study material. In my opinion, in the exam it will not come. This was a decade back when we were moving to Ind AS for the first time. At that point, they had given you a cutoff date. Cutoff date was 31st March 2014. So my Ind AS would mandatorily apply from 1617. My Ind AS would mandatorily apply from 1617, but then suddenly if I tell in there 1617, chalo, let us prepare as per Ind AS, companies don't have enough time to adjust. So they had said that if a company's net worth on 31st March 2014 crosses 500 crores, then come what may, that company has to mandatorily move to Ind AS in the year 1617. Are you understanding it? Now that created a lot of issues earlier, for which institute had asked you a couple of questions in study material. I don't think it will come in the exam, but for understanding, just to have that complete coverage, what happens if your net worth was 505 crores on 31st March 14? Will you have to follow Ind AS? From which year? Perfect. What if my net worth falls? I had a 505 crore net worth. Suddenly there are huge losses. My net worth falls to 200 crores in the year 31st March 15. You understand? I can have losses. Net worth falls to 200 crores in 31st March 15, 31st March 16, whatever. So there is a conflict. If I look at the last audited balance sheet, my net worth is only 200 crores. It's a big number, but it is less than the cutoff. But if I look at 31st March 14, my net worth is 500 crores. Do I need to follow Ind AS? Sure? Yes, the cutoff date was 31st March 14. So if on 31st March 14 you had crossed 500 crores, you have to follow Ind AS. No sir, but later we fell below, so what? On the cutoff date you are greater than 500 crores, you have to follow Ind AS from the year 1617 onwards, even if you made losses and your net worth fell. Or what happens if on 31st March 14 you had only 100, 200 crores of net worth? Is Ind AS mandatory? No. But by 31st March 16, your net worth becomes 600 crores. Now will Ind AS become applicable? Yes. So the general rule that you have to remember is, for the first time adoption, that is in the years 2016-17, Ind AS would be applicable if your net worth on 31st March 14 or any subsequent balance sheet is greater than 500 crores. So if on 31st March 14 it is greater than 500 crores, Ind AS applicable. Not greater than 500 crores, keep on checking. The moment it crosses, Ind AS becomes applicable. Will this come in the exam? Unlikely. Is it there in the study material? Yes. With 3 sums pertaining to this in the study material. ICI study material. We have not included it because I don't see a question of 2014 application coming now in 2024 or 25. Are you understanding it? So if you want to understand, I'll give you understanding of all concepts, whether we do sums or not, all concepts will be done. Sums you can always refer. Are we clear with this? Can we proceed? Okay, any questions, any doubts till now? Just a second. Any problems? No? Okay, so we'll go to the questions, quickly discussing them. So if we go to the questions, so over here at the start of your book, you will have a few things. You will have the past coverage. Across your books, there will be QR codes. Most of the questions will have them. So you can scan them and they will be linked to an audio note. This is a quick kind of something like this. This is a quick discussion about the question. So when you are revising, do we have to listen to everything? The answer is no. But if you get stuck at a particular place, then probably you can scan and recap that question. So we would broadly be discussing the question and common problem areas in that question. So that you can do. You don't need any encryption software or anything. You need an audio player, and through that you can scan and listen to the audio notes. We can do it later. So that is one. And secondly, there is a revision planner. where we have given you various kind of time frames, topic wise, hour wise, where you can kind of dedicate that many hours for your revision. So you can refer that. Yes? Okay. Same. Okay. So we'll go to the questions. So following is the structure of company D. So you have company D having a subsidiary E, subsidiary H, E further having a subsidiary F and subsidiary G, H having an associate. There are few associates as well. Now all companies in the above structure are unlisted companies and the net worth of company E. Okay, so this is your company E. The net worth of company E is greater than is 300 crores and net worth of all other companies is below 250 crores. To which company would Ind AS become applicable? Okay, understood the question? First, the company in question, company E, is Ind AS applicable? Because now the applicability is 250 crores and above. Unlisted companies, so Ind AS is applicable. Now, corresponding to that, for company F, is Ind AS applicable? It's a subsidiary. Company G, it is an associate. Even associate is covered? Yes. What about company D? Yes. Indirect applicability to the parent, definitely applicable. But the question is, what about company H? Sure, not mandatory. And below that, company I or any other company also not mandatory. If I want to follow voluntarily for H and I, we can very well follow, but mandatory application not there. Is everyone clear? Perfect. That is question 1. Then you go to question 2. There's a fairly detailed solution. You can refer it at your leisure time, but otherwise, even if you kind of broadly understand the essence of that question, you are good to go. Okay, then is question 2. ABC Inc. incorporated in a foreign country. Now this is interesting, okay? Now we said listed companies Ind AS is applicable. Listed companies where? Listed companies across the world? Across the world. So if I go to, let's say, Google or Coca-Cola, who are listed in US, will I force them to follow and make Ind AS statements? They have to do reporting in India. They have to do reporting in India. So most of these international companies don't do any reporting in India. And if they don't do reporting in India, Ind AS is not applicable. But if they do reporting in India, Ind AS becomes applicable whether you are listed in India or outside India. Is it possible that there are certain companies who are listed outside India? Like you have Make My Trip, for example. Naukri.com, for example. These were early movers in the IT space. They got themselves listed on the NASDAQ. But they are actually Indian companies. Make My Trip, Naukri, or InfoEdge, they are Indian companies, but they are listed on NASDAQ. They are not listed, let us say, on the Indian exchanges. But because they are Indian companies, they have to file to MCA, Ministry of Company Affairs. Whether they are listed in India or outside India, if you are doing Indian reporting, Ind AS becomes applicable. Unless given otherwise, a foreign company does not report in India. And hence, if it is incorporated outside India, Ind AS is not applicable unless it has to do Indian reporting. Are we clear with this? Okay. ABC Inc. incorporated in a foreign country has a net worth of 700 crores. Let us say question ends over here. And they ask you, is Ind AS applicable? Is it applicable? No, unless given otherwise, a foreign company will do no reporting in India. Ind AS is not applicable unless it is given that they are going to report in India. It has two subsidiaries, company X, whose net worth on 31st March 14 is 600 crores. And company Y, whose net worth is 150 crores. Whether X and Y would be required to follow Ind AS from accounting periods commencing 1st April 16 on the basis of their own net worth or on the basis of net worth of ABC. So over here, if you go to see what is happening, just a second. If we see, okay, so there is a company ABC Inc. and it has two companies X and Y. Now ABC has a net worth of how much? But it is a foreign company. So will Ind AS become applicable? So there is ABC. It's a foreign company and it has a net worth of greater than 500 crores. then it has two companies, X and Y. X has a net worth of how much? 600 crores. Y? 150. Are X and Y Indian companies? Yes. Acha, will Ind AS be applicable to X? Yes. Because of its own applicability. It is not because of parent's net worth, it is because of own net worth. But will Ind AS be applicable to Y? Will it be applicable? No. For its own net worth, it will not be applicable. Now comes the problem. If X is following Ind AS, will ABC also have to follow Ind AS? If it has to report in India, yes. But if it does not have to report in India, will it need to follow it Ind AS? No. Let's say it is a US company, like Google USA is a US company. It has huge net worth, it is listed. It has a wholly owned subsidiary in India, Google India Private Limited. Google India Private Limited has a net worth of more than 250, 500 crores, whatever it is. Google India prepares its financials as per Ind AS. But that does not force Google USA to prepare Ind AS because they don't have to report in India. They will prepare as per US GAAP only. Are we clear with this? So will ABC follow Ind AS? No. ABC will not follow Ind AS. Irrespective of that, ABC following Ind AS or not, will Y have to follow Ind AS? No. Acha, what if ABC was not a foreign company? What if ABC was an Indian company? Then will it follow? Yes. But still, will Y be required to follow Ind AS? I think we are clear about it. I'll again repeat, if ABC was a foreign company, ABC, irrespective of its own net worth or irrespective of its subsidiaries' net worth, unless ABC has to report in India, then it has to follow Ind AS. If it does not have to report in India, then it does not have to follow Ind AS. Unless given, we will assume foreign companies don't report in India. Are we clear? Now, if ABC was an Indian company, still Y Limited would say I'm a fellow subsidiary. If I'm a fellow subsidiary, I will not follow Ind AS. But ABC will say, nahi yaar, my net worth is greater than 500 crores. So I am not following Ind AS because my subsidiary is following Ind AS. I am following Ind AS because my net worth is crossing. Then will Y have to follow? Yes, then Y will have to follow because Y is a subsidiary of ABC and ABC has direct applicability of Ind AS, not an indirect applicability. Are we absolutely clear with this? Okay, so we have tried to discuss some alternative scenarios as well along with the core scenario which is there. So that is question 2. And last question 3. As per the roadmap, Ind AS is applicable to company X from the financial year 17-18. Here they tell you it is applicable. Company X, who is a non-finance company, is a subsidiary of company Y, who is an NBFC. Okay, let us say question ends over here. We don't have any details of the NBFC's net worth. So there is NBFC Y. I think Y is the parent, right? And there is a company X. Now, let us say we have no details of Y's net worth. X is complying with Ind AS. Will Y have to follow Ind AS? It's an NBFC. Sure? Think and answer. Will it have to? Forget it, everything else. Due to the group structure, let's say it is an NBFC, let us say it is a bank, let us say it's an insurance company. My subsidiary is following Ind AS. Does that mean I have to follow Ind AS? No. No, the answer is no. For an NBFC, for a bank and for an insurance company, application is own application. So if merely because my subsidiary, which is not an NBFC, is following Ind AS, does not mean I have to follow Ind AS. Are we clear with this? Okay. Y is an unlisted NBFC having a net worth of 400 crores. Okay. What will be the date of applicability of Ind AS for company X and company Y? Now company Y is an NBFC. NBFC's roadmap tells you what? That it is a +2 roadmap. So when I go to the year 16-17 +2, that is the year 18-19, my NBFC has to have a net worth of greater than 500 crores. Is it greater than 500 crores? No. In the year 19-20, my net worth has to be greater than Is it greater than 250 crores? Yes. Assuming the net worth continues to remain the same, my net worth is 400 crores. So the earliest that the NBFC will follow the Ind AS is the year 1920. No sir, but my subsidiary is already following Ind AS. Does not matter. My subsidiary is a non-finance company. Their applicability roadmap is different. NBFC applicability roadmap is different. Are we clear with this? Does not matter. Own net worth. It's non-NBFC subsidiaries or it's non-NBFC parents, you don't have to say. Okay. If Ind AS applicability date for NBFC is different from the applicability date of the corporate subsidiary, it is different. Like for the corporate subsidiary, NBFC, for the corporate subsidiary, Ind AS is applicable in the year 1718. Understanding? But for NBFC, we are saying it is applicable in the year 1920. Are the dates different? Can they be different? Yes. Then how will the consolidated financial statements of parent NBFC be prepared? So they are not asking you, they are saying that how will I prepare the CFS? So for the year, so if I were to summarize, for the year, let us say 1718, and for the year 1819, my parent NBFC Y, which is my parent NBFC, they will prepare their SFS as per what standards? AS. During this time frame, the subsidiary, which is a non-finance company, will prepare its financials, its SFS using what? Ind AS. But during this time frame, there will be a CFS of Y. This CFS of Y will be prepared as per what standards? AS. But for this, I will have to restate X financial statements into AS to the extent practicable. Understanding? The law for consolidation is the same. I will consolidate as per parent's accounting policies. The parent over here is NBFC, accounting policy is AS. Subsidiary independently is following Ind AS. But when I consolidate, I have to consolidate as per uniform accounting policies. Are we clear with this? And hence, I will restate XFS, that is financial statements, as per AS. Going forward, from 1920 onwards, will there be any problem? No, you look at X, you look at Y, you look at the CFS. All of them will be prepared as per Ind AS only. So there is uniform policies then. Are we clear with this? Are we understanding? Yes, okay. So that kind of takes care of the applicability section. From an exam perspective, I would put this into the tier 3 category. So there are 3 tiers. Tier 1 would be the most important. Tier 2 will be the average importance. Tier 3 will be the least important. So what you call as ABC analysis, this is similar to that. Applicability would be into the tier 3. You just need to know the basic applicability. You need to know a few exceptions. Exceptions, 3 notable exceptions. First is joint operation. Second is fellow subsidiary. And third is what if there is a finance company inside your group. How will you manage finance company? And at max foreign company. Beyond that, I don't see things coming in your exam. Even if they do come, they will come either for an MCQ or a short 4-mark theory question. Are we clear with this? Good to go? Yes, okay. So that kind of takes care of your applicability section. Now we, any problems? Last audited balance sheet, that is on the year. So whenever you are looking, let us say for 1920 applicability, you will look at the net worth on 31st March 19. For 1819 applicability, you will look at the net worth on 31st March 18. So we are assuming that the net worth is the same if no other information is given. If it continues to remain at 400 crores, then applicability will be from 1920, assuming 31st March 19 net worth is greater. Yes, please. That is right. So we will study that when we do Ind AS 101. So if Ind AS is applicable for the first time, we will just discuss that since a question is asked, but it's actually there in 101. So what happens is, if, just a second, if your company gets listed today and hence Ind AS becomes applicable from the current year. Now in the current year, let's say we are in the year 24-25, that will be my first Ind AS financial statement 24-25. But along with that, I also have to give a comparative. Comparative is the year 23-24. My 23-24 is already signed, audited as per AS. I don't have to go back to the auditor and change that. That is already done as per AS, that is AS only. But in my current year, when I give the previous year column, I will have to restate the previous year column as per Ind AS from the transition date. How you do that? Ind AS 101 guides you. But your first Ind AS financial statement will be 24-25 statement only, not 23-24. You might prepare a comparative of 23-24 as per Ind AS, but your signed financials were as per AS only. So first Ind AS financial statement is 24-25 only. Are we clear with this? Any other questions? Then a subsidiary will be applicable. Yes. So when I look at the group applicability is for NBFC and its NBFC subsidiaries. I will not look at, because they follow the same roadmap. The moment I am a non-finance company, roadmap is different. I will not see their net worth or not see whether they're following AS or Ind AS. But if I am an NBFC parent, I have an NBFC, it's a good question. So if I am an NBFC parent whose net worth is less than 250 crores, I have a NBFC subsidiary whose net worth is 1000 crores. For example, okay. So my NBFC subsidiary is following as per Ind AS. So will my NBFC parent move to Ind AS? Yes, because NBFC parent and subsidiary have the same roadmap. But non-finance companies have different roadmaps. So I will not look at my non-finance subsidiaries or non-finance parent. But I will definitely look at my NBFC subsidiaries or NBFC parent because they have the same roadmap. Are we clear with this? Yes? Okay. Perfect. So now we will go into core Ind AS. Okay. So this is Ind AS 16 PP. Have we studied this earlier in our accounting standards CA Inter as well? Goes under? Yes, 10. This is, I would put into, it's a very important standard. I will put this into the tier 1 category in terms of importance. If you do this properly, 2 other standards, by and large, intangible and investment property, also get by and large done. So this is kind of the base standard for 3 standards. Okay. So Ind AS 16 PPE, property, plant and equipment. So first of all, what do you mean by a PP? For something to be classified as a PP, it has to meet 3 check boxes. First, it has to be, what do you mean by tangible? Touch, feel, see, right? You can touch, feel, see. So basically it has physical substance, tangible. Second, it has to be held for use. Very important. It is held for use in the ordinary course of business and not necessarily held for sale. For example, if I'm a company like Toyota, Toyota manufactures cars. Usually cars, people take it as PP. Why? Because people use cars. But does Toyota use cars per se? Toyota is in the business of selling cars. So for Toyota, those cars would be what? Inventory. So it has to be held for use in the ordinary course of business. And third, it has to have a life of more than 12 months. Otherwise, basic stores and spares, consumables, etc., they have a life of less than 12 months. We will say, no, this is not covered. So it has to meet 3 check boxes. Tangible, held for use, and life more than 12 months. Now, when I look at use is a very broad term. Students usually confuse use with sales. They say, okay, something has to generate sales. Acha, if I have machinery in my factory that is used to manufacture output, is that covered under inventory? Is that, you are saying yes? Is that covered under PP? Yes, it is covered under PP. It is used, some people say that it is for use, it is manufacturing inventory which I can sell, it is definitely used. However, let us say if use is a very broad term, it can include manufacturing use, selling and distribution use, administrative use, employee welfare, etc. So let us say you go to a big multinational company, there is a big painting at the reception. Does that painting necessarily generate any revenue? But that painting is tangible. It has a life of more than 12 months. It is held for administrative use. Now it may be office decor. Some student might say, no sir, but it does not generate any further revenue. No, the law nowhere tells you it generates revenue. The law does not tell you PP is item which generate revenue. Law says PPs are item which are held for use, and use can include administrative use. So that painting in the reception, can that also be called as PP? Why not? It is a PP, it is held for use, administrative use. Use can be any kind of use. For example, if you see a lot of online videos, you have companies like Google, etc., which are very good workplaces. They have Xbox, PlayStation for their employees, for employee welfare. Then we compare it with our office. Right? Okay. So that way, does that Xbox or PlayStation necessarily generate any revenue for us? But still, is it held for employee welfare? Does it meet the 3 criteria? Tangible, life of more than 12 months, held for use. Don't confuse use with sale. There may be pollution control equipment. You might be environmentally conscious company, you want to cut down pollution, so you have installed some equipment. Yeah, that does not generate any further revenue. So be it. Don't confuse revenue and use. Revenue is different, use is different. By the way, if it generates revenue, well and good. But even if it does not, if it is held for use, that is, it is held for any kind of use, administrative, selling and distribution, manufacturing, it can be classified as PP. Are we clear with this? So there are these 3 conditions, and the life should be more than 12 months. It is also an important criteria to be called as a PP. Like for example, you have nuts, bolts, screws. These are called as consumables. They are also used. They are not sold. Sometimes loose tools. They are used, not sold. But usually nuts, bolts, screws will be consumed over the course of 12 months. And hence, usually we put it in the inventory category. We'll say, no, this is like raw material and consumable. They don't have more than a 12-month life. Stores and spares. Store and spare is a tricky part. It can come in an MCQ. A store and spare can be a PP. A store and spare can also be an inventory. Usually, if the life of the store and spare is more than 12 months, we put it along with the PP. If it is less than 12 months, we take it in consumables within inventory. So, nuts, bolts, screws, etc. will go where? Let's say they have a life of less than 12 months. They will go where? Inventory, stores and spares heading. Are we clear with this? Acha, on the other hand, when just general reference, okay, just for our understanding, a car has how many tires? 4. Actually 5 tires. Almost every car has a safety tire, that is a spare. So when I look at the spare tire, usually does a tire have a life of more than 12 months? A tire usually has a life of more than 12 months. Hypothetically, if I were to buy a car and a spare tire, the spare tire will be capitalized along with the car. For example, because it is a spare which has a life of more than 12 months. Do you understand it? So over here, it has to have a life of more than 12 months for it to be capitalized along with a PPE criteria. Barabar? Also, there will be something going further where this life comes into play. From a student perspective, this is it. But from a practical perspective, you also look at materiality. For example, you look at a calculator. Do we use a calculator, or are we in the business of selling calculators? Use. Usually you are also a little emotionally attached to your calculator. I mean, you probably have been using it for some time. So now when we look at a calculator, the calculator is held for use. So do we capitalize it along with PP? Technically, yes, it has a life of more than 12 months. It is tangible, it is held for use. But practically, for a 200, 300 rupees, that also if you buy original. So, for a 200, 300 rupees calculator, we will say that it is not material. If you are a CF firm has 10 employees, it has given every employee calculator. That is total 300 into 10, 3000 rupees. 3000 is not as material to be qualifying as PP, and hence people expenses out as office expenses in practice. In exam, question might tell you X buys a machinery of 100 rupees. We will not say it is not material. Let it be 100 rupees unless it is given that it is immaterial. Everything for us is material. Right? So in practice, one needs to remember that merely because these 3 criteria are satisfied does not mean everything becomes PP. These three criteria being satisfied and it being material, it becomes a PP. Materiality is subjective. Like wedding for us and wedding for Ambani's. There is different materiality. So that way materiality can be subjective. But nevertheless, from an exam perspective, we kind of skip that materiality angle and we look at these three criteria. Now this is regarding PP. Next you go to scope. Scope generally will tell you what is covered, more importantly what is scope exclusion. So if you meet the three criteria, it is PP. If you meet the three criteria, it is PP except. Well, there are three main exclusions. First, there is something called as non-current assets held for sale. Like I might buy a building. Is building held for use? Usually PP. Sooner or later, I might decide to sell it. Now, am I continuing to holding it for use, or now it is for sale? And hence, there is a separate standard called as Ind AS 105, non-current assets held for sale, where it will be going. So the moment it is held for sale, remember if it is sold, then it is not there in your balance sheet only. But the moment it is held for sale, it goes under Ind AS 105. Then there is another standard called as exploratory and evaluatory operations linked to mining. So this is covered by something called as Ind AS 106. Ind AS 106 thankfully is not there in your syllabus. It was there in the year 2018. But it was very technical because it is linked to mining. It had seismic studies, topography studies. Now we are already... So institute said that it is so technical, they thankfully removed it. So Ind AS 106 is there actually. It applies to companies like British Petroleum, ONGC, who spend a lot of time, money exploring whether there is oil below the surface or not. So if I'm spending a lot of money to figure out exploring and evaluating whether there is enough oil below the surface or not, what do I do with that expense? Can I capitalize it along with the mine? Can I not? That guidance is given under Ind AS 106 and hence it does not come under Ind AS 16. Are we clear with this? Loosely speaking, this is similar to research and development. Samajhte apan? What an IT company or a pharma company does for research and development, an oil and gas company does for E&D, exploratory and evaluation. So like research and development, if you are aware, has separate guidance in Ind AS 38. Intangible tells you by what to do with research, what to do with development. In a similar way, Ind AS 106 tells you what to do with exploration and evaluation expense. Long story short, that will not be covered under Ind AS 16. It will have a separate standard. In the exam, this is not important because 106 is not there in your syllabus. And last one is, in my opinion, the important part. So over here, this is what is important from an exam perspective, because there may be a case in the exam where you might have to decide which standard is applicable for biological assets. What are biological assets? Assets which have life. Biological assets. Generally, there's a separate accounting standard for biological assets. Any idea? Ind AS 41 is a separate standard on biological assets, and that standard will be applicable to biological assets in general. These are assets having life. Now, the standard subdivides biological. What is the heading of that standard? Any idea? Agriculture. The heading is not biological assets. Remember, it is agriculture. There's an important point for there so that you are aware. So biological assets used for agriculture are covered under Ind AS 41. There's one exception to that, something called as bearer plants. Have you heard about bearer plants? What is a bearer plant? A plant which bears produce and is not produce itself. For example, when you look at a coconut tree, does it bear coconuts? So you are holding the tree because it bears coconuts, or a mango tree or an apple tree. These are bearer plants. They bear produce, but they are not produce themselves. For example, you look at a sugarcane plantation. You look at a bamboo plantation. So in a bamboo plantation, can I say bamboo itself is a produce? And as a result, is bamboo plantation a bearer plant? No, because it is itself the produce. Whereas when you look at a mango tree, the tree is not the produce, the mangoes on the tree is the produce. So mango tree is a bearer plant, for example. Are we clear with this? We will come to that. But bearer plants are covered under Ind AS 16. Are bearer plants also living? Are they also biological? But the standard says we want to cover the bearer plants under Ind AS 16 category. Every other biological asset, living asset, other than bearer plants will be covered under Ind AS 41. Acha, is there something called as bearer animals? But the standard has no exception for that. All living animals will go under Ind AS 41 only. So all living animals used for agricultural purpose, like let us say cattle, or let us say sheep, or let us say goats, all of them will go under Ind AS 41 only. Are we clear with this? So biological assets used for agricultural operations except bearer plants. Okay, so when I look at biological assets or living assets, if I look at living plants, bearer plants, you guys tell me, bearer plants will be under which standard? 16 or 41? 16. Bearer plants will be under Ind AS 16. Other than bearer plants will go under which standard? 41. Okay, how do I? Okay, just a second. So if I look at other than, can you call someone? So over here, just a second. Yeah, so just quickly discussing, when we look at bearer plants, for bearer plants, which standard is applicable? 16. But other than bearer plants? 41. And for all living animals used for agricultural purpose? 41 only will be applicable. Now, we will try to understand bearer plants in a limited level. So, bearer plants bear produce and are not produced themselves. But does every bearer plant automatically come under Ind AS 16 merely because it bear produce? For example, when you look at a wheat plantation, wheat grain. So you have a wheat plant, there are grains, and that grains are the produce it bears. Right? So technically, if I have a wheat plantation, will it be a bearer plant technically? Because it bears produce. The tree itself is not the produce. The grains that it has, that is the produce. So is it a bearer plant? Technically yes, but if it's a bearer plant, it will come under Ind AS 16. If it comes under Ind AS 16, then PP principles will apply. But if PP principles apply, the life has to be more than 12 months. Achha, usually when you look at all of these agricultural croppings, you have the Kharif season, Rabi season, the wheat plantation grows, I will cut this entire plantation, then have another plantation. Does it have a life of more than 12 months? No. So remember, this life of 12 months is important, because unless my life can be proven to be more than 12 months, I will not say it is a bearer plant. For me to be a bearer plant, my life has to be more than. Does a coconut tree survive beyond 12 months? Similar is for mango tree, etc. They survive beyond 12 months. A bamboo tree also survives beyond 12 months, but bamboo tree itself is the produce. So for it to be a bearer plant, it has to bear produce, but at the same time, it should not be an annual crop. It should not be something which has a life of less than 12 months. If it is a life of less than 12 months, no, we will not take it within the Ind AS 16 principle, because if it is Ind AS 16, it is PP, but PP has to have a life of more than 12 months. So for something to be a bearer plant, very important, first, it should bear produce. Second, it should have a life of more than 12 months. And third, eventually, if you decide to sell it, that should not be the incidental sales, are like salvage value. Like eventually I have a mango tree, 10, 15, 20, 30, 40 years. Now the tree becomes old, I chop it down and sell the wood. So someone will say the tree itself is also the produce. No, but that was never the main objective. It was incidental, it was ancillary. But for bamboo, that was the primary thing. Are you understanding the difference? Yes, okay. So incidental or scrap sales are not considered while determining it's a bearer plant or not. So for every plant which is other than bearer plant used for agricultural purpose, Ind AS 41 will apply, and for living animals also Ind AS 41 will apply. Now in the exam you might have basic things. Okay, so in the exam what do we remember? What are bearer plants? Typically fruit plantations. See, we are not doing biology, so we don't know so much about all of these plants and stuff. So in the exam, how will we know it is a bearer plant or not? The general thumb rule is fruit plantations and cash crops like tea, coffee, rubber, cotton, etc. are treated as bearer plants by default. So if you see a question where there is a grapevine, or there is a mango tree, or there is a coconut tree, all of these fruit plantations, or tea leaves. Okay, if you see tea crops also, people just take the leaves and they trim the crops. They don't uproot it. They have a life of more than 12 months. So if you open Tata Tea's balance sheet, you will see the tea plantations as bearer plants covered by Ind AS 16, because Tata Tea has tea plantations, right? So tea, coffee, rubber plantations, and you have fruit plantations in general are assumed to be bearer plants. But institute can ask you anything. Like in one of the past RTPs, they have asked you about a plant called as Pineus radiata plantations. Now people doing biology will also not know that, right? Okay, so Pineus radiata we will never know. So in such cases they will explain to you. So in the RTP question says the company has 100 Pineus radiata plantations and these trees have a life of 30 years and are going to be used ultimately for building materials and furniture. So what do you guys think Pineus radiata is? Is it a bearer plant or not a bearer plant? Sorry? Very nice. In the exam, this is where it becomes difficult. If you see a question, they will tell you, but you will have to figure out whether it's an Ind AS 16 question or 41 question. Now it will be easy, because if you're doing 16, all 16 questions are here, 41, all 41 questions are there. In the exam, that becomes difficult, right? So we have to figure out, ask yourself, the moment you see a living plant, living animal, ask yourself, right? Okay, that whether it is bearer or other than bearer, at least for plants. Acha, when it comes to living animals, in general, they will go where? Provided they are used for agricultural purpose. What is agriculture? We will study in 41, but we have a broad idea of what is agriculture. We will study in detail in 41. Is a security dog or a police dog, is that used for agriculture purpose? But is that dog a living animal? So will that dog go under 41? 41. Living animal, there's no bearer, non-bearer. We are saying living animals, Ind AS 41. Will that, and this is also an RTP question, will a security dog go under 41? Why no? It is not for agriculture. What is agriculture? We will study in detail, but definitely security is not agriculture. So over here, Ind AS 41 will cover only living animals which are used for agricultural purpose. And security dog or animals in zoos, for example, are not for agricultural purpose. They will not go under 41. Then where will they come? They will come back to 16. So when we say biological assets, students generally have this impression in their mind that all biological assets 41. Galat hai. It's wrong. Only biological assets for agricultural purposes will go under Ind AS 41. Other biological assets like security dogs or animals in zoos will still continue to be under Ind AS 16, because 41 will not take it, because they are not used for agricultural purpose. Are we clear with this? Yes, okay. But cattle, for example, if there is a company like Amul, and Amul is having cattle and cattle is used for milking purpose, is that animal husbandry, for example? Is that within the larger definition of agriculture? Yes, Amul will take this as a biological asset under Ind AS 41. Are we clear with this? But a security company, let's say there are Tops Police or something, a security company who has recruited Alsatians, bought Alsatians for security purpose. Well, they would say that no, these dogs are for security purpose. They're not for agriculture purpose. They will go under Ind AS 16. Are we clear with this? Okay. One small thing before we proceed further from this section is, what about human resources? Are we also biological? Do we have a life? So where should we be covered? Should we be covered under Ind AS 41, biological assets for agriculture purpose? No. So should we be covered under Ind AS 16? Will we? No, not even Ind AS 16. In assets, but that is expense. I'm saying as asset. Very nice. Okay, so human resources, are they assets in the first place? Are you are you guys assets? Okay, usually human resources should be assets. But how is an asset defined? An asset is defined as a resource controlled by the entity due to past events for which an entity can get future economic benefits. Do you give future economic benefits? Yeah. Okay, so hopefully yes. So we do give future economic benefits to our entity, but the problem is, in most cases, can a human resource be controlled? No, we cannot be kind of controlled like an animal can be tied. We are not as, I mean, we might be struggling in articleship, but we are still not as, you cannot be controlled. You have your own will to leave whenever you want. Articles being an exception, you have to stick around, but generally people can leave when they want to, and hence an entity cannot be said to have control. They give benefits, yes, but human resources cannot be controlled, and hence in general, human resources will not be shown as assets. There are exceptions, and we will study this probably in tomorrow's class. Like when you look at players, with players you have agreements, contractual rights, which are very strong rights. Like if you follow football, a couple of 3-4 years back, Lionel Messi and Barcelona had some issues. Arguably the best footballer of the world and one of the richest persons, he also could not leave Barcelona because the penalty clauses are so severe that, well, he has to continue with that club till the contract expires. That exhibits control that Barcelona has over Messi. They don't own Messi, but they have the right to obtain his services. So it is more like an intangible, a right to obtain services, which in certain cases can be shown as an intangible asset. But in general, when you go into an employment agreement, in general, you can give a 1 month notice and leave. That does not show sufficient control over you. And as a result, almost in all company balance sheets, you will not see human resources as an asset in the first place. Let alone Ind AS 16, let alone Ind AS 41, let alone Ind AS 38. It will not be an asset because we don't control. And there are questions on this area in the intangible section. Are we clear with this? Yes? Okay. So a quick recap on biological, on living assets. So first of all, you have living assets. Living assets can include human resources. Are human resources covered under any standard? What is the reason for that? Does not have control. Second, other assets. That is living animals and living plants. Within living animals, bearer plants. Covered under? Bearer plants. Covered under? Ind AS 16. Other than bearer plants used for agricultural purpose, 41. Living animals used for agricultural purpose, 41. Other living animals which are not used for agricultural purpose, 16. That can be, for example, in amusement parks you have dolphins. Dolphin shows happen. I own those dolphins, but I'm not using it for agricultural purpose. I'm using it to run a dolphin show. It is not Ind AS 41. Living animal, no, but still not Ind AS 41. Are we clear with this? What is agriculture? We will study it in Ind AS 41, but as of now, do we have the clear understanding? Important from an MCQ perspective, or important from a question where identification has to be done. After that, you do the accounting, but first you have to identify, like the Pineus radiata question. Are we clear with this? Yes? Okay. So that is regarding bearer plants and stuff. We'll probably stop for a break at around 9:15 if that's fine. Yes, we'll stop for you can have breakfast at around 9:15, and so we'll go to the initial recognition part of PP. Now, when I look at initial recognition happens at what value? So, okay, just what are we going to cover under PP? 4 main areas. You will have initial recognition that happens at cost. Second, subsequent expenditure. How do you record? Subsequent valuation in the balance sheet, and what do you do with depreciation? 4 areas. Okay, first is initial recognition. Initial recognition happens at what? Cost. Now, what all should be included in cost? Will my purchase price be included in cost? The invoice price. But what if there are discounts? Should I, let's say 100 rupees is the MRP and 40 rupees is the discount. 60 rupees is what I'm paying. Should that 40 rupees be deducted while calculating cost? Yes, so my cost should be how much? 60 net of discounts. When there are discounts, there are 2 types of discounts. Which 2 types? Trade and cash. How do you define a cash discount? A discount which is linked to early or prompt payment. And how do you define a trade discount? No, not necessarily, but everything other than a cash discount is a trade discount. You might be buying 1 unit, but you have very good negotiating skills. You just stick around and you say, no, I want a display. They get fed up and give you a 10 rupee discount. You have not bought in bulk. So what is that? Is that a trade discount or a cash discount? A discount which is other than cash is defined as trade. Don't think that it is only bulk discount. Any discount which is other than cash discount is defined as a trade discount. So when I buy a product and if I am making a payment due to an early payment, cash discount, should that also be deducted while calculating cost? No, but should a trade discount be deducted? Yes, cash discount is usually taken to the profit and loss account. Like for example, if I buy a product for 100 rupees, they give me a 3-month credit period. I say, no, I will pay immediately. They will say, okay, then you pay 95 rupees. So they give me 5 rupees cash discount. My journal entry will be asset account debit 100 to bank 95 to discount received 5, and that discount received will go to the P&L. On the other hand, if I go, the asset is worth 100, there is no credit period. You have to make cash payment across the counter only, but I negotiate hard and I say give me at 95 rupees. They give you at 95 rupees. Now what is a journal entry? Asset account debit. How much? 95. To bank? 95. Are we able to differentiate the two? If it is a cash discount, it is financing in nature. If it is trade discount, it is operating in nature. Cash discount is linked to early payment, financing in nature, and hence I show it separately. Trade discount is linked to your business relationship, to your negotiating skills, to your bulk buying, whatever, but it is not linked to early payment. It is operating in nature, linked to operations, reduce it from cost. Are you able to understand this? It is based on GAAP. GAAP is generally accepted accounting practice. Cash discount, financing in nature, show it separately. Trade discount, operating in nature, reduce it and show the asset net. Is everyone clear? That is regarding discounts. Second, so if let us say I were to buy a machine from Germany, pay 100 rupees for the machine, but I have to pay some custom duty. So let's say I have to pay 50 rupees as custom duty. So for me, will my cost be 100 or will it be 150 rupees? Will the 50 rupees custom duty, basic custom duty that I pay, will that be a part of the cost of my asset? Sure? Okay. Okay. However, if I were to buy it in India, and let us say pay GST, 100 rupees plus 18 GST, and let us say for that 18 you can get credit in some way. Will my true cost be 100 or 118? 100, because for the 18 I'm going to get credit. And as a result, what I will add to my cost is going to be non-creditable taxes. If it's a creditable or a refundable tax, then I will not add it to my cost. For example, if I were to buy a machine at 118, for which 18 I am going to get credit, what will be my journal entry? Asset account debit 100, GST receivable account debit 18, to bank 118. Then by around 20th of each month, when you find the GST or 3B, you will take credit. Let us say you have to pay 20 rupees. You will say, no, GST payable is 20, GST payable account debit 20, to GST receivable account debit 18, to bank 2 rupees. So basically, I am receiving credit. But if I don't have a GST number, like I think most of you will not have a GST number. So you look at the bottom line only. For you, GST or no GST, you will look at the bottom line for you. If you were to buy a machine and you don't have a GST number, can you take credit? No. So for you, the true cost of the machine is how much? 118. So your entry will be asset account debit 118 to bank 118. No, but 18 is GST. But what will I do with GST? If I put a separate GST asset, I will never claim credit of that. So for me, that is 18 extra paid for the asset only. And hence, I will add the non-creditable, non-refundable taxes into the cost of my asset. Are we clear with this? Okay, so this is purchase price plus non-creditable taxes less trade discount. Is that it? Are there any other expenses that you can possibly add? Are there any other expenses that you can possibly add? Yes. For example, if I'm importing a machine from Germany, I might be paying freight for transporting the machinery. Should that be added? Loading, unloading charges, installation charges. Yes, all of these are expenses which are directly attributable in getting your asset in the ready to use condition. Now, one can always argue that whether this expense was required or not. Now, one can always say that I took insurance while transporting the goods. So, a student might argue that goods can come to India even without insurance. We are no one to challenge that. If the company has incurred an expense which is directly attributable to purchase, maybe it's a fragile item. Had there been no insurance, I would have never imported it. So if it's an expense which is incurred in the course of purchase, whether it was required or not, sometimes what happens is people do primary packing, they even do secondary packing. One can say that, okay, they can come even by primary packing. No, even secondary packing costs can be capitalized because it is directly attributable to purchase. If an expense is directly attributable to purchase, you can capitalize it, rather you have to capitalize it. In basically getting the asset in the ready to use condition, you will capitalize it. Are we clear with this? Okay, the institute gives you fairly good guidance on what is not a directly attributable expense. So they don't tell you what is that. They say directly attributable anything which is linked to getting the asset in ready to use. Like you buy this AC and this AC gets installed. Installation technician charges 1500 rupees. Will that be capitalized? Because without installation the asset is not in the ready to use condition and hence that will be capitalized. Are we clear with this? Okay, now what is not directly attributable? This is given in the standard and hence you have to follow that. They have given you 4 items which are not directly attributable and hence will not be capitalized. First is inauguration expenses. What do you mean by inauguration expenses? For example, now this was debatable and hence people said that, so for example, if you buy, let us say, an asset and you get, let us say, someone like Deepika Padukone to come and inaugurate. So she cuts a ribbon and she charges a bomb for that. Will that be capitalized along with the cost of your project? Because it is not directly attributable to construction, or I mean, it might give you some publicity, etc. But it has no direct connection to getting the asset in the ready to use condition. And hence it will not be capitalized. On the other hand, so what was the problem? Why did the institute have to give you this guidance? Like for example, when people, like in India, we are quite spiritually connected, right? So when we buy an asset, let's say we buy land, we call our Panditji and we say that, okay, we want to do some puja. He comes and does some Bhumi Pujan and only then work starts. So that entire cost that you've spent for Bhumi Pujan, will that be capitalized? That entire puja that you did, someone can always argue that unless Panditji had told me a yes, I would have never done anything. That is also like inauguration expense only, no? I'm trying to, will that, so it becomes contentious. People would say, no, Deepika Padukone is separate story, Panditji is separate story, right? Okay, so will that still be capitalized? No, the standard says a bottom line, any kind of inauguration expense is linked to inaugurating a project, you will not capitalize along with the cost. Because it is, we don't think it is directly connected to constructing the asset. You might do it for whatever purpose, but it is not linked to constructing the asset. So from now on, any kind of inauguration, whether it is done at the beginning or at the end of the project, it will not be capitalized. Are we clear with this? Point 1. Point 2 is some losses or expenses are after the asset is ready for use. For example, when Jio started, a lot of you might have Jio SIM cards. Why did you start with a Jio SIM card? Because initially everything was free. So Jio started. Now Jio will have a very big fiber optic network, a very big cable telecom network. Acha, was that telecom network ready for use? Yes, but they were not charging you anything. They were incurring losses. Okay, let the customers first install that SIM card. They did not charge you anything. So Jio, let us say, spend hypothetically 10,000 crores behind telecom towers. Is that a cost to construct the towers? Yes. Will that be a part of the cost? Yes. The towers are now ready for use. They roll out SIM cards. They roll out SIM cards. They give you SIM cards free of cost. They give you, let us say, data connection free of cost. They incur losses for 2 years. Will that losses be capitalized along with the cost? Will they be capitalized? Okay, an argument can be that these losses will give me future economic benefits. Because I am getting my customer base, and now they've increased their fares also. If you're aware, the tariff is increased. So I can now milk my customer base. But my initial losses, the argument was earlier that these losses will be capitalized. I don't want to take it to P&L because these losses will give me future economic benefits. The law of cost does not say that every cost which gives future economic benefits capitalized. No, the law says every expense till the time the asset is ready for you should be capitalized. Achha, by the way, you might keep on incurring expenses. Those expenses might give you future economic benefits in the future, but that does not qualify as cost to be capitalized. So the law has put it out loud and clear. They said losses and expenses after the asset is ready for use. Like Jio might incur 2 years of losses. Again stuck. So over here, Jio might incur, I don't know why this is happening. Jio might incur 2 years of continuous losses. Will those losses be capitalized? Will those losses? No, because they are losses after commencement of the project. Are we clear with this? So subsequent expenditure guidance is different. Initial cost you will not capitalize. Subsequent expenditure is a separate guidance, but it is not to be capitalized along with the initial cost. Yes, okay. Third is, let us say, cost of staff training or operating in a new environment or set of new customers. So when I look at staff training, earlier this was a very contentious point, that if I am incurring staff training, I should capitalize it along with the cost of the asset. The standard says no. For example, you were to buy laptops. Now your staff is technologically illiterate. They don't know how to use a laptop. You are training your staff how to use a laptop. You are giving them courses. Is a laptop ready for use? Your staff does not know how to use it, does not mean that the laptop cost should be capitalized. Or, this is a very simple example. Now, one can argue that, let us say, Boeing comes out with the new aircraft. Now, if Boeing comes out with a new aircraft, pilots have to be trained on that, right? Pilots know flying, but the actual technicalities of the new aircrafts, pilots have to be trained on it. So Boeing, when it gives a new aircraft, it will always include training for the pilots. It will say that, okay, and companies will take those training programs, let us say, for the pilots. And as a result, people would say, okay, let us capitalize. But are the flights ready for use? Maybe pilots need to be trained, but that should not increase the cost of the asset. It has no connection in the asset is ready for use. Maybe people don't know how to operate it. So the standard has made out a thumb rule, because earlier a lot of training costs used to be capitalized. Some of them appropriate, some of them not appropriate. So they said, let us end this story. Let us remove all kind of training cost. Any training cost, the asset is ready for use. You don't know how to use it, that does not matter. The asset is ready for use. Are we clear with this? That is point number 3. And point number 4 is relocation expense. What do you mean by relocation? Relocation means the asset is already in the location and condition as desired by the management, and now I am relocating it. So that is subsequent expenditure. It will not, so I mean, hypothetically, okay, let us say I were to buy an AC. Let's say I am from Mumbai. I buy an AC and I install that AC in my premise. Is that AC ready for use? Now, I am very emotionally attached to my AC. Hypothetically, if I remove it and take it wherever I go and keep on installing it, do entire Bharat Darshan with that AC. I am removing the AC, installing it where I go. I am removing it in, that is all expenditure. But one can always say that in Chennai that AC will not work unless it is installed, but the AC was already in the location and condition. Now you are relocating it, taking it to 10 different places, does not increase the cost of the AC. That is expense for you. That does not make the AC more and more expensive. Otherwise, that's a 30,000 AC plus 1500 in Mumbai, then again another 1500 here, then again 1500 there. The standard says no, that is relocation. It is expenses which are incurred to bring the asset in the location and condition is desired by the management should initially be capitalized. After that, if you keep on relocating the asset, that subsequent relocation cost should again not be capitalized. Are we clear with this? There might be certain exceptions to this when you go to the subsequent expenditure section, provided you can prove that such a relocation will increase the life and efficiency of the asset. Then in certain cases as subsequent expenditure you can capitalize, but other than that you cannot capitalize. Are we clear with this? So over here 4 thumb rules, and these are mentioned in the standard, so you have to follow. This is not gap, this is standard, black and white written as a clause in the standard. These are 4 items which under Ind AS 16 framework will not be capitalized. Which are those 4 items? First, inauguration. Second, losses after the asset is ready for use. Third, staff training. And fourth, relocation or retraining expenses. These will not be capitalized in general, at least as a part of the initial cost of the asset. Are we? Yes, please. So So for example, if I were to kind of link this, like let's say you have redevelopment projects, have you heard? So you are demolishing the existing building and you are creating a new building, right? So if you are demolishing the existing building, that demolition cost is necessary to construct the new building. It will be capitalized along with the cost of the new building, the demolition cost. So then in the new line you can capitalize because it is necessary for the new line to come in, but that will not change the cost of the old line, for example. In the new line, if this cost was necessary directly attributable to construction of the new line, then you can definitely capitalize it along with the new line. Okay. And otherwise the generally accepted principle is administrative, selling and general overheads will not be capitalized because they are administrative in nature, selling and distribution in nature. Are we clear with this? Okay, now you look at directly attributable expense. There is a possibility of a directly attributable income. What do you mean by income? Usually the asset is still being constructed. It will usually not generate income. However, there might be certain cases where it generates a directly attributable, it generates an income. Should that income be, okay, if it's income, does it increase the cost or does it reduce the cost? So should it be reduced or should it be taken to the P&L? Usually to P&L, well it kind of depends. So if, for example, if that income is directly attributable to a direct cost of construction, you can reduce it from the cost of the asset. However, if it is not directly attributable, then you can take it to P&L. For example, if I am doing a redevelopment project, I am demolishing existing structure, it costs me 50 crores to demolish. I get some debris, I sell those debris and get 10 crores. Is that income? But is that income directly linked to a cost of construction, demolition? So can I say my net cost of demolition is 50 minus 10, that is 40? So when I do the redevelopment project, I will say that 50 minus 10, that is 40, is my net cost of demolition. It is directly attributable income. It is directly connected to a cost of construction. Are we clear with this? Yes? Okay. On the other hand, for example, let us say if I am constructing a building, and if you watch movies, you will see that most of the times the fight sequences are in under construction building. The villain is almost always over there. Right? So over here, Rohit Shetty is passing by. He says, okay, this is a building in very bad shape. It's an ideal site for my movie shoot. He comes to you and he says that I want the site for 2 months. You give it for 2 months and you earn some rental income. Is that directly attributable to any cost of construction? So is it to be taken to the P&L or should it reduce it from cost? P&L. So if something is not directly attributable, like the land is lying vacant, you give it out on rent, or the building, you give it out on rent and earn some income, you will take it to the profit and loss account. However, if it is directly attributable to construction, you can deduct it. Are we clear with this? Yes, okay. So these are the core items when it comes to determination of initial cost. The same, this is for a purchased asset. The same also applies for a self-constructed asset. Just that in case of a self-constructed asset, rather than having a purchase price, you will have your cost sheet, direct material, direct labor. What about overheads? There are 3 types of overheads: factory, administrative, selling and distribution. Will all the 3 overheads be a part of cost? No. Will factory overheads be a part? Within factory overheads, there is fixed and variable. Will both? Yes, both of them will be a part of cost, and this is where students make a mistake. They do make a mistake over here. In general, we have seen a question where you are constructing a building and you will be given some guidance. Okay, when I say overheads, does it mean cash overheads or all overheads? Including non-cash? Like for example, if I'm constructing a building and I'm using a crane to transport something, you understand? Now that crane, I own that crane and that crane is ready for use. The depreciation on that crane is 100 rupees during the current year. I don't have to pay rent to anyone, I own it. But for the entire year, when the building was being constructed, the crane was used for construction. 100 rupees was the depreciation on the crane. Usually the entry is depreciation account debit to crane account and then P&L account debit to depreciation account, nominal. Here also I will do depreciation account debit to crane. But then will I transfer the depreciation to P&L account or will I capitalize it along with the building? Are you understanding? See, usually if I were to take the crane on rent and if I were to pay rental expense, is that a directly attributable expense for constructing my building? Would I have capitalized it? But if, let us say, I own the crane, I don't have to pay rent to anyone. Now what do you guys think? Now will I have to incur certain, will I have depreciation charge? But is that directly attributable to getting my asset in the ready to use condition? My crane is ready to use but my building is not. So will the depreciation on the crane, 100 rupees, be capitalized along with the building? Yes or no? My entry will be, if there is a 1,000 rupee crane, my entry will be depreciation account debit 100 rupees. 10 years is the useful life of the crane. To, let us say, crane account, motor vehicle, whatever it is, 100. But depreciation is a nominal account. Ideally, it will be transferred to the profit and loss. Here, instead of transferring it to the profit and loss, I will transfer it to the building. I will say that this 100 that I am incurring to depreciation is directly attributable to construction of the building. Are we clear with this? Students, for some reason, have this thing in their mind that expense to be capitalized or only cash expense. The law nowhere tells you that. Law says directly attributable expense. Yeah, directly attributable expense can be cash, they can be non-cash. The law nowhere tells you that only directly attributable cash expense should be capitalized. As long as the expense is directly attributable. Is it directly attributable? Yes, the crane was directly used for your building the entire year. So that expense is directly, no, but we have not paid it. Where is the law telling you anywhere? We are not doing capital budgeting. We are not preparing cash flow. We are actually doing accounting, and in accounting, non-cash and cash sit at the same level. So there have been exam questions on this area where you have had a situation, and we'll do it in class today, the depreciation on a machine used to construct the asset. People say, no, this is depreciation, so it will go to P&L. If it is depreciation directly attributable to the asset, we should capitalize it. Some students get even more confused. They say, no sir, the asset is being constructed. How will it be depreciated? You are not depreciating the building. Building is still capital work in progress. There is no depreciation on the building. This is depreciation on a crane which is used to construct the building. They are two different things. Are we clear with this? Everyone? Yes, okay. So when we say factory overheads, we include fixed and variable and also include cash and non-cash. Everything will be included for factory overheads which are directly attributable. However, if the question tells you there are general overheads, you understand general overheads? Generic in nature, there is a head office and on that head office there is some depreciation. Will that be directly attributable? General overheads, the word general itself means it is not directly attributable. If it was directly attributable, it is not general. The fact that it is general, it is not directly attributable. Are we clear with this? Yes, okay. So, material cost, labor cost, production overheads. Okay, there are two things. One we will do on the other side of the break, but before that, borrowing cost. What do you guys think? Usually is borrowing cost capitalized? Always? It depends on whether your asset is a qualifying asset or not. So if I am constructing a building which is taking 3 years, I don't have money, I've taken some loan and there is some interest that I'm paying on that loan. Should that be capitalized? Yes, because it is interest for constructing a qualifying asset. But if I'm, let's say, assembling a machine which is going to take only 2 months, my story is the same, I still don't have money. I take loan, pay interest for 2 months. Will that 2 months of interest be capitalized? Where will that interest go? Why? It is not a qualifying asset. For you to capitalize, Ind AS 23, similar to AS 16, tells you that borrowing cost should be capitalized only if it is attributable to a qualifying asset. Other than that, borrowing cost should not be capitalized. Where should borrowing cost go? P&L. Have you thought about why? Why is there a standard only, just for our knowledge and deeper understanding, why is there a standard only for borrowing cost? Labor cost also can be incurred for 2 months. No? Like interest is incurred for 2 months. 2 months you are incurring labor cost to assemble a machine. Do you capitalize labor cost? Let us say you want to assemble something, you get labor for 2 months. Will you capitalize labor cost for 2 months? But it is not a qualifying asset. Still, do you capitalize labor cost? You don't have money, you pay interest. Do you capitalize interest for 2 months? No. Why no? Standard has told us. But why standard has told us? Remember, because ideally, interest cost should never be capitalized. It's not qualifying or non-qualifying. It should never be capitalized. Why? In CA Inter, remember you have done cost sheet. You have done a chapter where there is a reconciliation between financial accounts and cost accounts. Always in that reconciliation you will find finance cost, interest cost. Cost sheet says finance cost is never a cost to construct an asset. So whether as per generally accepted cost accounting principles, interest cost will never come in your cost sheet. Do you agree to that? But labor cost will come. Now whether labor cost is for 2 months, 2 years, 20 years, if it is to construct, it will always come. Interest cost, whether it is for 2 months, 2 years, 20 years, in cost sheet will never come. So if you follow the same principles, finance cost should never be a part of cost because it is financing in nature, not operating in nature. But if you go to accounting, matching concept will be disturbed. If 5 years you are constructing asset, 5 years you are paying interest cost, as per costing principles in each of the 5 years you will keep on taking finance cost to P&L. You are not earning anything. So standard says, okay, let us bend the cost accounting principles in light of materiality and let us capitalize it only for material assets. But generally interest cost should never be capitalized, and hence we will say that matching concept will be impacted only if it is a 2-year, 3-year, 4-year asset. For a short-term asset, we should not, interest cost should go to P&L, it should go to P&L only. But for assets which is taking long life, matching concept may be disturbed, and hence a separate standard was needed. Labor cost, where is there a separate standard? Material cost, where is there a separate standard? Because generally accepted, it has to be a part of cost. Borrowing cost, not generally accepted to be a part of cost. So a separate standard is needed that in these cases you take it as a part of cost. Are you understanding it? That is why you need AS 16 or Ind AS 23. Is everyone clear? But even if you don't know that, it is fine. As long as you're able to remember that it is a qualifying asset, and qualifying asset you capitalize, that is more than sufficient from an exam perspective. Are we clear with this? Yes, okay. So we will stop at this point, and site restoration we will do on the other side. It is an important area. We will do it on the other side of the break. Be back in around 30 minutes. Yes, okay. So be back in 30 minutes.